Ni hao, tao zi chong. It means hello investors. You may say, your Chinese is so good. How and where did you learn Chinese? And there is no secret from you guys. Google Translate is my best teacher for today. But this video will be about Chinese companies, behemoths such as Alibaba, Tencent, and Yum China Holdings. Are they too risky for investors because of the Chinese government's new policies and regulations? Today we will analyze both China giants and smaller but fast-growing firms.
谢谢收看。
It means thank you for watching. Hi, my name is Dmitry Bonder. Hope you're doing well and stay because you feel that when Chinese companies fell about 30%, it's quite juicy opportunity and time to buy Chinese stocks, huh? China's most well-known companies are starting to look cheaper to some US investors. Through the likelihood of volatility means there will be an ample opportunity to buy. And there are one of the most interesting companies to watch. Alibaba, one of the world's largest online retailer, is also a home to China's dominant cloud computing business and myriad others. And before the derailment of Ant's IPO last fall, it traded at 30 times earnings. Today it's closer to 15 times next year earnings and has 73 billion in cash. That's a fraction of what Amazon trades at, even though the two e-commerce giants both earned about $22 billion in fiscal 2020. And Alibaba sales are growing faster than Amazon's. Alibaba controls almost half of the e-commerce in the country and is at the center of making sure China has a vibrant economy moving from manufacturing to consumption. And this is still a company that has a lot of growth in front of it, just not as unbridled as before. There are company-specific risks that have nothing to do with China's political effort. Competitive pressures has been intensifying in Alibaba's aggressive investments to catch up with younger rivals like Meituan and Pinduoduo, depressed near-term earnings growth prospects. Analysts expect sales to rise 30%. So it seems like the company will be growing and there is a great chance to invest in this growth. One more company that we have to watch is a Tencent. Tencent is another company which worth your attention, guys. It has fallen 30% in the past 6 months, but the company's core mobile gaming business is under less competitive threat than Alibaba's core business. Unlike Alibaba and other big internet companies, Tencent, whose WeChat app has more than 1 billion users, never listed in the US, and it has recorded of being proactive in addressing government concerns. For example, it recently introduced a 1-hour limit for children under the age of 12 on their games and the limits in game purchases. The impact of the crackdown aimed at younger gamers should be limited, since the minors made up just 0.3% of gaming revenue in the second quarter. But what is interesting, folks, that even non-tech companies have been swept up in the sell-off. For instance, shares of Yum China, its American Fortune 500 fast food restaurant company incorporated in the United States with the operational headquarters in Shanghai, fell 5% in the past 3 months. Yum's price drop was aimed at another round of COVID lockdowns, but the company navigated the last year's lockdowns well, and its scale and experience should help it emerge as a survivor in a market field. And what is cool, Yum could double its network in 7 to 8 years. Plus, China redistributive policies aim to reduce in-house education and healthcare costs, about give lower-income consumers more money to spend on eating out. So the average 12-month stock price target from analysts on FactSet sees Yum China stock could grow about 20%, but ultimately the message for investors is one of the cautious optimism. China is still a major source of global growth and home for diligent savers, being encouraged to put more of their $75 trillion in household wealth into a stock market filled with the companies well positioned for Beijing's policymakers. And that's attractive terrain for long-term stock pickers. Just one that requires a clear sense of the risk and careful footing. US investors have largely focused on China tech giants, but given the situation today, there are better options, in my opinion. I gathered the top 5 fast-growing China stocks you should check as well. These are Li Auto stock, NIO stock, BYD stock, Sohu stock, and Weibo stock. For instance, Li Auto is one of several Chinese electric vehicle makers that trade in the US, competing with each other and Tesla. While still losing money, Li Auto has seen huge sales growth from its one current model, the Li One SUV, and Li One is actually a hybrid with a small gasoline engine to extend its range. And the automaker reported that revenue soared almost 160% to almost $800 million. Another interesting company is NIO. NIO is the most established of the Chinese electric vehicle startups. NIO has 3 electric vehicles, the ES8, ES6, and the crossover EC6. The company is not yet profitable, but revenue growth is very strong. Revenue soared 600% in Q1 2021 versus year earlier, when China was at the height of its coronavirus crisis. NIO has begun Norway deliveries for its ES8 SUV, kicking off a European expansion. So I tried to explain you a little bit what second echelon companies you have to check if you want to invest in China. But investors should be aware of significant risk with investing in Chinese stocks. The authoritarian state and its regulators can impose sweeping restrictions, fines, or bans on major companies, often with the little notice or transparency. That risk has been very apparent over the last several months. For instance, the Communist Party's Central Committee on August 10 issued a new 5-year plan that calls for greater regulation across a broad scope of businesses and the economy, triggering fresh losses on Chinese stocks. One more example, the Ministry of Industry and Information and Technology issued a set of draft rules governing competition among online platform operators. One more example, China approved a new data privacy law, raising concerns of further crackdowns on internet firms and companies that rely heavily on consumer data. I'm sure you heard about this. Also, China is drafting rules that would ban data-heavy Chinese firms from going public in the US. And one very good question, how to minimize individual China stock risks? The answer is via ETFs. Another advantage of buying ETFs is that a growing number of Chinese companies are listed in Hong Kong or Shanghai in addition to the United States. For instance, I really like and bought a pretty big position in a KWEB ETF QWEB that are US listed or traded, and this ETF included Alibaba stock, GD.com, Tencent, Pinduoduo, Bilibili, and some other really cool companies. But KWEB also holds companies listed on Chinese markets. So if you don't want to go specifically in some stocks, just buy KWEB and that will be enough. Thank you for watching this video, guys. Consider to subscribe, follow the link in the description if you want to open Webull or Robinhood account, and I hope I help you to understand better Chinese stocks and opportunities that you have with these stocks, as well as risk. See you and bye.